Okay, so imagine you're dropping, 10 grand on this pristine, custom-crafted Italian leather sofa.
Oh, wow. Okay. Setting the scene.
Right. So you bring it home, you unwrap it, and then you just, you put it outside on the patio in the rain.
Yeah, that is a terrible idea.
It's completely absurd, right? You bought this absolute perfect piece of furniture, but because you put it in the wrong location, you were just completely destroying its value.
Totally ruined.
And today, we're looking at how high net worth investors do the exact same thing with their wealth. I mean, you obsess over what stocks or funds to buy, but you completely ignore where you are actually placing them.
Which is, honestly, it's the ultimate blind spot. You can pick absolute winners across the board, the perfect index funds, the most reliable bonds. But if you place them in the wrong type of tax account, you are effectively springing a slow, invisible leak in your portfolio.
An invisible leak that can drain hundreds of thousands of dollars over a lifetime.
Exactly. And because the IRS takes its cut so quietly over decades, most people never even realize they are bleeding out.
So today, we are doing a deep dive into a really comprehensive guide from Thomas Davies at Davies Wealth Management. They are a fee-based fiduciary out of Stuart, Florida.
Right. And this specific material actually forms the backbone of a lot of their discussions on the 1715 Treasure Coast Financial Wellness podcast.
Yeah, and our mission today is to decode what they call asset location strategy and explore their 7 proven rules for tax-smart portfolio placement. So, okay, let's unpack this, because right off the bat, we have to distinguish between asset allocation with an A and asset location.
Yeah, that distinction is everything. I mean, asset allocation is the what? It's the pie chart. It's your decision to hold, say, 60% of your money in global stocks and 40% in bonds.
That dictates your overall risk.
Right. But asset location strategy is the where. Once you decide to buy those bonds, where do they physically live?
Like, do they go into your individual taxable brokerage account? Your traditional IRA?
A Roth.
A Roth IRA.
Exactly. For investors who have accumulated over $1 million, mastering this specific placement strategy is quite literally the difference between that invisible wealth erosion we talked about and just massive compounding growth.
I'm going to put some real numbers to this invisible erosion because the guide highlights this research from Vanguard's advisor Alpha Group.
Oh, yeah, the Vanguard study.
Yeah, they found that a proper asset location strategy can add between 0.20% and 0.75% in after-tax returns every single year.
And to put that in perspective, if you apply, say, a 0.5% drag to a multi-million-dollar portfolio, compounding over a 20 or 30-year retirement horizon, we are talking about surrendering hundreds of thousands of dollars to the IRS.
Money that should have been yours.
Completely yours to spend or pass on.
The guide gives this fantastic concrete example of how this happens. So picture a 58-year-old executive. She has a $3 million portfolio, and it is split across 3 different buckets. So $1.2 million is sitting in a standard taxable brokerage account, $1.1 million is in a traditional rollover IRA from an old job, and $700,000 is in a Roth IRA.
A very common setup for a high earner.
Right. But if she doesn't have a location strategy, she just does what most mass market robo-advisors do. She buys the exact same 60-40 balance fund in all 3 accounts.
Which is just, well, it's the default setting for the industry. Mass market algorithms are built for scale, not nuance.
Right.
It is incredibly cheap and easy for a large national firm to just blind stamp the same model portfolio across every account you have. And it feels balanced to the investor.
But holding that identical balance fund everywhere is a disaster for this executive.
Oh, absolute disaster.
The guide actually calculates that mirroring the allocation in all 3 accounts creates a $15,000 to $20,000 annual tax drag. That's 20 grand a year just vanishing.
It's gone. Poof.
If it is this damaging, how do smart, successful people keep making this mistake?
Well, I think it comes down to human psychology. We like symmetry, But having a taxable account, a traditional IRA, and a Roth IRA simultaneously means you have 3 entirely different tax environments.
The IRS treats the money in those accounts completely differently.
Exactly. So you have to strategically sort your assets based on how they generate returns.
Which brings us to the sorting phase of our deep dive. Let's start with the assets that get hammered hardest by taxes. Things like taxable bond funds, high-yield bonds, and REITs.
Right. Real estate investment trusts.
Yeah, for anyone unfamiliar, REITs own commercial real estate and spin off a ton of rental income to investors. The guide is incredibly clear here. It says all of these high tax cost assets need to go straight into the traditional IRA. Why is that the designated home?
Because of how the IRS categorizes their growth.
Right.
The interest from those bonds and the dividends from those REITs are classified as ordinary income.
Okay.
So if you hold a taxable bond in your standard taxable brokerage account, the interest it pays out every month is taxed at your highest marginal income tax rate. Oh, wow. So for a high earner in 2026, that could mean surrendering 37% of your yield directly to the federal government.
Right. Over a third of your return is just gone before you can even reinvest it.
That's brutal.
It is. But look at what happens when you place that exact same bond inside a tax-deferred shelter, like a traditional IRA. That income compounds without the IRS taking a cut every year.
So you don't pay a single dime in taxes until you eventually withdraw the money in retirement.
Exactly. You are shielding your most heavily taxed assets from that annual drag.
Okay, so if we are sheltering the heavy income producers in the traditional IRA, what goes into the Roth IRA? Because the guide insists that the Roth is reserved exclusively for your absolute highest growth assets.
Yes, aggressive small cap growth funds or, highly volatile emerging market equities.
Why specifically those?
Well, this requires a fundamental mindset shift about what the Roth actually is. The Roth IRA is the single most valuable tax shelter you will ever own in your lifetime.
Because the growth inside a Roth is completely tax-free forever? Right. Not tax-deferred. Tax-free.
Let's run a scenario on that, just to be clear. If you put $50,000 of a speculative high-growth tech fund in a taxable account, and it skyrockets to $250,000 over 20 years, you're going to be hit with massive capital gains taxes the moment you decide to sell and lock in that profit.
Massive. But exactly the opposite happens in the Roth. If that explosive growth happens inside the Roth IRA, every single dollar of that $200,000 gain is federal income tax-free when you pull it out.
The IRS cannot touch the winnings.
Never. That is why you want the assets with the highest potential appreciation living in that specific bucket.
But, if you're a high net worth investor, the government doesn't just let you dump unlimited money into a Roth, right?
Unfortunately not.
Yeah, in 2026, the direct contribution limits are just $7,000 or $8,000 if you're over 50. And if your income is too high, you can't contribute directly at all.
Which is why the guide emphasizes advanced maneuvers, like the backdoor Roth conversion, or executing Roth conversion ladders during years where your income happens to dip.
So for high earners, the goal is constantly finding legal pathways to maneuver capital into that tax-free environment.
Precisely so, those high-growth assets have a place to run wild.
Okay, that makes total sense.
Right.
So we've placed our heavy tax income producers in the traditional IRA and our massive growth engines in the Roth. What about the core of most people's portfolios? The standard, broad U.S. and international equity index funds? Where do they live?
Those belong in your standard taxable brokerage account.
Really? Why the taxable account?
Because broad equity index funds are incredibly tax efficient by nature. They don't spin off a ton of ordinary income. Instead, they grow primarily through price appreciation.
Oh, okay.
So when you eventually sell them, they are taxed at favorable long-term capital gains rates.
And in 2026, those long-term capital gains rates are generally 15 or 20%, plus the 3.8% net investment income tax for high earners.
Exactly, and that combined rate is still vastly superior to the 37% ordinary income rate hitting the bonds we talked about earlier.
So you are perfectly matching the tax character of the investment to the tax rules of the account.
Bingo.
I understand the math, but let me just push back on how this actually feels in practice.
Sure, go for it.
If I'm listening to this and following along, my safest assets, my steady bonds, are now locked away in a traditional IRA with strict IRS withdrawal penalties before retirement.
Right.
Meanwhile, my most volatile, aggressive assets are in my Roth, and my core stocks are in my taxable account.
Correct.
If the market suddenly tanks, or I have a massive medical bill and need cash immediately, doesn't this setup make withdrawing money a total logistical nightmare?
What's fascinating here is that you are separating your portfolio's overall risk from its physical location. We have to completely decouple those two concepts.
Okay, how so?
Your overall risk profile hasn't changed one bit. Let's say your target is still 60% stocks and 40% bonds globally. If you suddenly need emergency cash and your financial plan dictates that you should sell bonds to get it, you don't actually have to withdraw money from the IRA where the bonds live.
Hey, how does that work? If the bonds are in the IRA, don't I have to sell them and take the money out of the IRA?
No, think of your different accounts as different rooms in the same house. You don't care which room the heat comes from, as long as the house overall stays at 72 degrees.
Okay, I'm with you.
If you need cash, you can sell the bonds inside the IRA, but leave the cash in the IRA. You then immediately buy stocks inside the IRA.
Oh, I see.
Simultaneously, you sell the exact equivalent amount of stocks in your taxable account to generate the actual cash you withdraw to pay your bill.
Ah, so the overall ratio of stocks to bonds in the house stays perfectly balanced at 60-40. You just shifted which room they were in to get the cash out of the taxable account without ever touching the IRA.
Precisely. You are using the accounts as one unified, fluid system. You aren't taking on more market risk. You are strictly optimizing your moves to accommodate the IRS's rules.
Okay, since we established that standard equity index funds should live in the taxable account, we should talk about how to weaponize that specific account when the market drops.
Yes, tax loss harvesting.
The guide calls this supercharging the taxable bucket. How does this work?
Well, it is an incredibly powerful tool, but it only works if you place the assets correctly. Let's say you have a $2 million equity portfolio in your taxable account. A recession hits, and the market drops heavily.
As it does.
Right. Several of your index funds dip below their cost basis, meaning they are currently worth less than what you originally paid for them. Tax loss harvesting is the strategy of intentionally selling those losing positions to lock in or capture that loss for tax purposes.
But you don't just leave the money in cash, right? You immediately reinvest it into a similar fund so you don't miss the rebound when the market recovers.
Correct. But you have to carefully navigate the IRS's wash sale rules under Publication 550.
Right. They don't make it easy.
No, they do not. You cannot sell an S&P 500 index fund at a loss and then buy the exact same ticker symbol back the next day. The IRS will disallow the loss.
And what do?
You have to buy something substantially different, like swapping an S&P 500 ETF for a Russell 1000 ETF.
And the result is brilliant. The guide says in a volatile year, a disciplined investor might generate $30,000 to $60,000 in captured tax losses.
Which is huge.
Yeah, you can bank those losses and use them to offset future capital gains when you sell your winners. But here is the critical tie back to our location strategy. That loss harvesting maneuver is completely useless inside an IRA.
Utterly useless. Losses inside an IRA or a Roth have zero tax benefit. You cannot deduct them.
Wow.
If you had placed your broad index funds in the IRA instead of the taxable account, you would have completely forfeited the ability to harvest those losses during the downturn.
It really is all about placement.
It is.
Now, the guide issues a massive caution sign regarding one specific asset: municipal bonds.
Oh, the ultimate trap.
They call it a trap, yeah. Municipal bonds generate interest that is exempt from federal income tax. For an investor in the top tax brackets, a muni bond yielding 3.5% is actually the equivalent of a fully taxable bond yielding over 5%.
Right. And this is exactly where placement dictates reality. The IRS has a very rigid rule. Any withdrawal from a traditional tax-deferred IRA is taxed as ordinary income. Period.
They don't care where the money came from.
The IRS does not care how the money grew inside the account.
So if you put a tax-free municipal bond inside a tax-deferred IRA, that is like wearing a raincoat inside a submarine.
Yes.
It is totally redundant. You're wasting the coat, and frankly, you're doing it wrong.
That analogy hits the nail on the head. Think about the self-sabotage here. You take an asset that the government has explicitly told you is tax-free. You place it inside an IRA. And by doing so, you magically transform that tax-free interest into taxable ordinary income the moment you withdraw it in retirement.
You've effectively volunteered to pay taxes you didn't know.
Exactly. Municipal bonds absolutely must go in the taxable brokerage account where their tax exemption actually functions.
Incredible. Now, as wealth scales up, the assets get far more complicated. We aren't just talking about stocks and bonds anymore.
No, it's definitely not.
A lot of high net worth listeners have private equity, hedge funds, or real estate partnerships. And the natural assumption is, oh, I'll just throw my private equity into my IRA, so this massive alternative growth is tax deferred.
And that assumption can trigger a staggering administrative nightmare. Private equity and private credit held in an IRA can unexpectedly generate something called UBTI.
UBTI.
Unrelated business taxable income.
Okay, if you're listening to this and thinking, wait, I have to file a separate tax return for my retirement account.
Yes, that is exactly the headache we were talking about.
But why does the IRS care? I mean, it's a retirement account.
It comes down to fairness in the open market. The IRS created IRAs to encourage passive investing, like buying stocks. But private equity often involves taking ownership stakes in active operating businesses.
Ah, I see.
The IRS doesn't want your tax-exempt retirement account running, say, a commercial plumbing company tax-free, allowing it to unfairly undercut the taxable plumbing company down the street.
That makes sense.
Right. So to level the playing field, if your alternative investment generates UBTI, the IRS taxes it inside the IRA. You have to file a special, highly complex tax form called a 990T.
So suddenly your pristine tax-sheltered account is generating an annual tax bill.
Exactly.
And the guide also points out the trap with non-REIT real estate partnerships. Real estate is famous for generating heavy depreciation deductions, which investors love because it lowers their tax bill.
Right. Everyone loves depreciation.
But if you hold that real estate partnership inside an IRA, all of those depreciation deductions are entirely wasted. You only benefit from depreciation if the asset is in a taxable account where you have taxable income to offset.
Which is why alternative investments demand a really careful case-by-case analysis. You cannot blindly force them into the standard buckets.
Let's pivot to the human element of all this, because the guide stresses coordinating this strategy across spouses and business entities.
Right.
We are talking about optimizing across his IRA, her Roth, the joint taxable account, the solo 401k, maybe a SEP IRA.
It gets complicated quickly.
It does. And let's be real, if a married couple keeps their finances somewhat separate, optimizing perfectly across all these accounts requires radical financial transparency. How does that work in reality?
Well, this raises an important question about how couples view marriage and money versus how the government views it.
Okay.
You might view your accounts as distinctly separate from your spouse's, but I can assure you the IRS views you as a single combined household for tax purposes.
Right.
If you try to optimize your traditional IRA in a silo and your spouse tries to optimize their Roth IRA in a separate silo, you are almost certainly leaving significant value on the table.
Because the husband might be holding bonds in his Roth to make his specific account feel balanced, when those bonds should have gone into the wife's traditional IRA to serve the whole family's tax strategy.
Exactly. The location strategy has to transcend individual account titles. It has to look at the household as one unified ecosystem.
Okay, here's where it gets really interesting. We've mapped out how to build this portfolio perfectly for today. But the guide introduces this fascinating concept about how all of this impacts you decades down the line.
Right, the healthcare stuff.
Yes, specifically regarding your healthcare costs. Let's talk about the IRMA trap.
This is where asset location strategy evolves from a niche investment tactic into the absolute linchpin of holistic retirement planning.
Yeah, so IRAA stands for the Income-Related Monthly Adjustment Amount. To translate that out of government speak, it is a surcharge that Medicare slaps on your Part B and Part D premiums if they decide your income is too high in retirement. In 2026, those surcharges kick in when your MGI, your Modified Adjusted Gross Income, hits over $106,000 for a single filer, or $212,000 for a joint filer.
And if you haven't managed your asset location properly during your working years, hitting those penalty thresholds in retirement is terrifyingly easy.
Let's walk through the math from the guide, because it is wild. Let's say you spent your whole career dutifully packing money into a traditional IRA, but you ignored location strategy.
Okay.
You kept your bonds in there, sure, but you also kept a bunch of high-growth stock funds in there, too. By age 73, thanks to decades of growth, that IRA has ballooned to $2 million.
Good problem to have, right? But at age 73, the IRS steps in and mandates that you start taking required minimum distributions, or RMDs.
You are no longer allowed to defer the taxes.
Exactly. You must start draining the account.
Right. So a $2 million IRA generating just a 4% mandatory distribution means you are forced to take out $80,000 of ordinary taxable income that year, whether you need the money to live on or not.
Now, stack that $80,000 on top of your Social Security benefits, maybe a pension or any other income you have. Remember, MGI pulls in almost everything.
Right.
Suddenly, your income blasts right through those IRMEA thresholds.
And boom, your Medicare premiums skyrocket. The guide notes these surcharges escalate through 5 different tiers, potentially adding over $500 per person per month to your healthcare costs.
It's massive.
Think about that. An allocation decision you casually made in your portfolio at age 45 is directly dictating your monthly Medicare premiums at age 75.
If we connect this to the bigger picture, it shows exactly why you have to actively manage these tax buckets long before retirement.
So how do you fix it before it happens?
Well, if this investor had utilized Roth conversions during their lower income years, they could have shrunk the overall balance of that traditional IRA.
Okay, and a smaller IRA means smaller future RMDs.
Exactly, which would have kept their NGIs safely below the Medicare surcharge thresholds.
Speaking of Roth conversions, the guide points out a huge mistake people make when they try to fix this. When they finally do a conversion to shrink the IRA, they ignore the location strategy entirely. They just convert their steady, low-growth bonds over to the Roth.
Which completely defeats the purpose of the Roth.
It's because it's not growing.
Exactly. You want to convert your highly appreciative equities. When you move an asset from an IRA to a Roth, you aren't just converting the principal amount, you are moving all of its future explosive growth into a tax-free environment.
Right.
You never waste a conversion on a low-growth asset.
Another final mistake the guide flags is failing to use new cash for tax-aware rebalancing.
Oh.
When the market shifts and your portfolio gets out of whack, human nature says you should sell your winners to buy the losers to get back to 60-40.
Right.
But if you do that in a taxable account, selling those winners triggers immediate capital gains taxes.
Which is why the smartest investors use new contributions, or the dividends that are naturally spun off, to buy whichever asset class is currently underweight.
Ah, so you don't sell anything.
Right. You gently restore the balance of your portfolio without ever triggering a taxable event. Rebalancing just becomes an extension of your asset location strategy.
So what does this all mean? If there is one massive takeaway from Thomas Davies' guide, it is that treating your multiple investment accounts as isolated, separate silos is the biggest hidden cost in a high net worth portfolio.
Absolutely.
It is simply not enough to buy good funds. You have to put them in the right home.
It is an ongoing discipline. It requires coordinating across your accounts, your spouse's accounts, your business entities, and just constantly adjusting as tax laws change and your personal income levels shift over time.
And if you're listening to this and experiencing a sinking feeling that your luxury leather sofa might be sitting out in the rain right now, Davies Wealth Management actually offers a financial wellness quiz and a complimentary fiduciary audit.
Oh, that's great.
Yeah, you can map out exactly where your assets live and see mathematically whether your current structure is bleeding tax alpha.
It is absolutely worth mapping it out. But I want to leave you with one final, slightly provocative thought to mull over.
Okay, let's hear it.
We have spent this entire time discussing a highly optimized strategy built entirely around today's tax code.
Right.
It relies heavily on the precise gap between long-term capital gains rates and ordinary income rates. But what happens if Congress fundamentally rewrites the rulebook?
Oh, wow.
As you build this beautiful, perfectly tuned multi-account tax engine, you have to ask yourself, are you building a machine that only works on today's roads? And how quickly could your location strategy pivot if the government completely changes the speed limit?
That is a fascinating question to chew on.
Isn't it?
Until next time, keep diving deep.